just everybody introducing themselves and what their specialties are and get to know each other. A lot of us know one another, but really don't know what we're doing. Again, for those of you with children who are having to face the dilemma of whether to send the kids to school or not, or bring them back or not, or they're isolated, I feel for you. Luckily, mine are a little older. Still have my own worries and mishigash I'm concerned with, but that's neither here nor there. So with that, we could start with Laurence Scot. See, if I say Larry, it's like everybody jumps up at once.
Let's see. We can't even use the initials because the Lawrence Shearer is LS.
Yeah.
Right.
And okay, so we can't even say LS. All right.
Right.
What's your middle name first?
Peter.
Okay, LPS.
LPS. All right. I'll start the ball rolling since it sounds like you all know each other. Yeah, I'm another Lawrence with a U, but everybody calls me Larry. It sounds too formal. I am a co-manager and co-creator of a small CPA firm called Scot and Company. We're in Midtown Manhattan near Penn Station. Like most CPA firms, we started off doing what everybody does, which is pretty much everything. We'll wash your windows, we'll do write-up, we'll do bookkeeping. But since my background was big corporate and dealing with larger businesses, we started tilting that way. And about 15 years ago, went solely towards not-for-profits. Our firm currently, which is in business 30 years, we're celebrating 30-year anniversary this December, has now servicing about 650 not-for-profits locally, nationally, and internationally. We are probably only one of 2 or 3 firms in New York City that specializes in not-for-profits. I know my competitors, but there's only like 1 or 2 others than myself and my firm that specialize. What we do mostly is audits, reviews, consulting, and return preparation. That's 990s, 990EZs, 990PFs for private foundations, and a lot of consulting to not-for-profits, which is pretty much covers everything. Aside from that, let's see, probably like most of you, I've been on boards, I've been a chairperson. For the accountants on this video, you guys know everybody wants to get a CPA on the board. That way they get you to do work for nothing. So I've done my chairperson, treasurer, board member. That's what I do for a living. For actually more of my passion is teaching. I've taught undergraduate and graduate, and guys, you accountants, there's no way you could pay me enough money to teach a basic accounting course again. Debits and credits are just mind-boggling to starters. But what I do go towards is I created specialized not-for-profit training courses, which I started at NYU, Baruch. I've gone to Fordham, and I'm now doing through Manhattan College. It's basically in not-for-profit accounting and financial reporting. Let's see what else I did. I do seminars all over on the subject, and I was an author of a desk reference book. I don't think there are many out there on accounting for not-for-profit and how to form a not-for-profit and how to report. That's basically the short version.
Excellent. Larry Bloom.
I'm also Lawrence with a U. Go by the name of Larry as well. Never been on a call with 3 Larrys. It's not usually the most popular name in the group, but certainly not being used in today's environment. I am part of a 11-person firm in Jericho. The name of the firm is Bloom Schoen CPAs. I guess I've been doing my own gig since 1991. We work primarily with privately held companies and professional practices. Most of our clients are small business, handful of middle market companies. When I say small business, which would be 5 million and under in revenues, we have a handful that are over, including one that's substantially over, but most of our wheelhouse is smaller companies. It could be manufacturing, distribution, a lot of real estate, some service-based companies. We don't do any not-for-profits. We have some non-profit companies, but non-profitable companies, but no not-for-profits, except for a few private foundations. We don't do, things like employee benefit plans or broker dealers. We kind of try and stick to a handful of industries. And we are full service in that we not only are taxed, although we are primarily tax driven because they're privately held companies, we do, audits, reviews, compilations, whether it's needed for partnership agreements, banking relations, or bonding relationships. So again, like you said, accountants generally cast a wide net, get involved in a lot of little things, and then start reeling it in and picking and choosing the areas that they enjoy working with. That's basically it.
Thank you. Mr. Shearer, we'll mix it
Okay.
up.
Taurus.
The third
Taurus,
Larry.
and my name is Larry also. I am a recovering accountant. That is, I was one of those guys who woke up one day, realized I just passed the CPA exam and I can't get out fast enough. I went on to law school, and now what I do is wills, trust and estate, and business succession planning. I founded a law firm that now has, we've gone from boutique into general practice. We have a real estate department, bank closing department. We are one of the few firms that do ITAR work, international trafficking and arms regulation, business succession, estate planning, elder law, and administration probate. That's us.
You got it. Cool breeze. Cynthia.
Good morning, Cynthia Relis with Oracle Profitability Consultants. I'm a certified bookkeeper and a profitability consultant. I've been in and out of the accounting world for a little over 20 years and work well with CPAs and professional advisories to help support them with their clients. I help set up books and records and make sure the financial statements are prepped and ready for the CPA so that they can do the tax returns. I streamline the processes within the businesses that tie back to the accounting systems. And I also work working with several CPAs and their clients on the PPP loan forgiveness applications. So I have several, I'm actually knee deep in that right now. Working with a lot of clients on the applications. And of course, we're waiting to see if SBA is gonna, or the government's gonna release the new rulings and the additional funding. So that's me in a nutshell.
Terrific. Thank you. And Mr. Kanyak, Phil, baby, what's happening?
Good morning, everyone. Phil Kenyak, forensic accountant. I'm a business appraiser and a damage calculation expert. Testified in courts up and down the East Coast. And I've been doing this specialized niche for about 30 years. I am a partner at Nussbaum, a full service accounting firm with about 85 employees with an office in Melville and One Penn Plaza, although I'm in Melville today. There's no one here. There were 3 other people yesterday and 1 person on our city office. I do a good deal of my work for trusted estate areas for planning purposes, and then I do it as a reaction to litigation and troubles. And I'll prepare a report for testimony, ultimate testimony. I found it interesting to comment on Cynthia's working on the PPP loan forgiveness. I just did a valuation of a company who already swept the PPP loan into income and has no intentions of paying it back, but they haven't filed yet. If they didn't already have negative working capital and negative equity, I would have been concerned about the issue. But the company was a dog, and it'll stay a dog. So I did not adjust that out. But those are the types of things I'm seeing. I'm working on a company now that does billing in the medical world for artificial limbs. and I suspect it's for a matrimonial. All of a sudden, their billings disappeared the last 4 months of the year.
Yeah.
With a December date of action, I assume the 2018, I assume the 19's earnings are going to be a lot different than the 18. And this particular, and I started my forensic world in 1990 doing matrimonial work, and I learned a long time ago the term income deficiency syndrome is a chronic illness that many property spouses go through during the pendency of the matrimonial action. But it goes away, the good news is. And they get all better once the divorce is finalized.
Once the stress has been removed.
Yeah. Well,
Attorneys
thank
can-
you. And Jeffrey, are you, can you want to unmute yourself and introduce yourself? If you're there? Okay. Maybe you're not there. So anyhow, most of you know me, Neil Himmelstein. I am an independent wholesaler of insurance products. I do specialize in high net worth, complicated cases. I've worked with Larry for many years on estate issues, such as moving a policy into a trust or out of a trust, buy-sell agreements. We work very well together on that planning mode. And on the sophisticated load, Larry's helped me a great deal on putting trusts together when we need it. I think estate planning is coming back in vogue quicker than ever because of the deficit that we're in right now, both citywide, statewide, federally. There's going to be changes in the tax code. Some of the changes are going to be involve the estate taxes, almost certainly. That's the easy target. Capital gains is another target that may be affected. But whatever it is, we're going to be prepared because we discuss on a regular basis what those changes are and how to react. But the best time to prepare is now. Interest rates are extremely low, so there's a lot of leveraging going on. And I think that the nonprofit world and the charitable giving is going to be a big piece of the estate planning piece, which is why I invited Larry to speak today, Larry Scott. I got to stop calling everybody Larry because half the room is Larry's today, because the use of some of the planning tools involve charitable and nonprofit work, and I think we can all work well together and play nice in the sandbox. So with that, I do want to have LPC take it away. Thanks.
LPC.
LPS.
Oh,
LPS, there you go.
all
I'm
right.
sorry.
That's okay. I've been
I
called
need
a lot. I've been called a lot of things.
That's
Uh,
okay.
Since we have a couple accountants in the room, and Cynthia, you're working on the PPP, you probably all know this, and just stop me if you do, but I was a little shocked when I started looking at the rules on the PPC, got into it, about the IRS, what they're doing with what they were supposed to do and what they are doing. So guys, stop me and I'll go right on. But if you don't know this, you'll find this interesting. So the PPP, when it came out of Congress, said that we're going to give you guys this loan, and if you pay salaries, you can convert it into a grant, and it's non-taxable, and that's to have you pay for your employees and help the economy. The IRS took a different position, and similar and different. They said the PPP money, when it gets converted to a grant, is tax-free, but the expenses related to that can't be deducted. So if you guys don't know that, it's really important, because in essence now they're converting that conversion back to a taxable act. So Larry, were you aware of this?
Oh, absolutely. But I look at it a different way. I mean, yes, it would be nice if the loan forgiveness were not taxable and you get to deduct the expenses used with the proceeds, which would be in effect a double dip.
Right.
If I look at it from my perspective, somebody paid my employees' salaries and they produce for me. Yes, I don't get to deduct it, but somebody covered the cost and I got the benefit of their production. So there still is a win. Yes, it's not the greatest home run, but it's still a win for companies.
Absolutely. And
Yeah.
that's what a lot of people have said. The only counter to that I heard, and it doesn't really affect a lot of our clients, are people in the restaurant and hospitality.
Yeah.
They've been saying, you know what? If I didn't think that this was going to be totally tax-free, you're right, a double benefit, I would not have hired these people. I probably would have closed up or done something. Now I hired them. Now I'm letting them go later, and now I don't have the benefit because I can't deduct the expenses. So I did something I wouldn't have done for tax planning.
Right. But
that's
what they should have done is come out with the 24-week period sooner so that the restaurants could have delayed taking the loan
right.
and then did it.
But I still believe Congress is going to change that. I don't think that was their intent. Their intent was be free. But again, you know it, Larry. I don't know if the other Larry knew that or Cynthia, but I think it's really important because a lot of people are thinking that it's really totally tax-free, and in essence, it's not. It's like getting extra revenue, is what you're saying. Somebody's giving it. Anyway, that wasn't part of my presentation, but you were talking about PPP. So, Neil, you want me to go on?
Yes, absolutely.
Okay, I'm going to share my screen.
All right, let me, hold on a second.
Okay.
I'm just going to make you the host for a minute here.
Okay.
There's another way of doing this, but I'm not sure how, but
Yeah, we're all learning the Zoom operation. Should I go
Okay.
on? Okay.
You are now host.
Okay, there we go. All right, you should be seeing this.
Here we go.
Okay, so that was just my first slide, which I've been asked to speak about a couple of things you guys are going to talk about. Also, split interest agreements, and I'm going to talk about two of those. And I decided to add to that some permanently restricted endowments, which kind of tangentially work with split interest agreements and other kind of trusts. I already covered my background, so no point in going into that. Before I go into anything with the not-for-profits, I just thought of some statistics might be interesting. I usually cover this in my class. And this is why a lot of firms are jumping into the not-for-profit world. Take a look at some of the numbers over the last 30 years. In about 20 years, which is 10 years ago, from 1990s to 2000, the number of not-for-profits that apply for exemption with the IRS has pretty much doubled from about 1 million to 2 million. That's phenomenal in growth in the industry. And up to now 2020, there are 1.9. So it hasn't grown that much from 2010. The reason is, for those that know, they changed the rules in 2010. Anybody that does have a not-for-profit client, if you do not file your tax return, your not-for-profit tax return, 990, 990EZ, and 990N, you will lose your exemption. So a couple of 100,000 lost their exemption in 2011. So then it got back up to 2 million. This excludes, by the way, a number of so-called not-for-profits that do not file, are not required to file, religious organizations. There are a couple of 100,000 that under the law do not have to register for exemption. They're automatically exempt, which means that we might have somewhere between 2 million and a couple hundred to 2.5 million not-for-profits in the United States. And take a look at this little statistic. In the number applying each year. Every year for the last 10 years, the number of applications have been somewhere in close to 100,000. In fiscal year 18, it was 91,000 plus, and in fiscal year 19, 101,000 plus. Out of that, almost all of them get approved. That means every year, the number that are applying to be a not-for-profit is going up 100. What they don't talk about is how many have lost their exemption, which means knocks the number down. Another interesting statistic, the number of people work in the not-for-profit world constitute 10%, give and take, of the private workforce, and account for a little over 12 million jobs. So it is a major component of our economy. And another statistic I heard is if you put all the not-for-profits together, the religious, the public charities, the foundations, you probably would be the third largest industry under maybe retail and manufacturing in the United States. Okay, now I'll jump into the subject matter.
Quick question, Larry.
Sure.
So if you were if you wanted to form a non-for-profit, who would you go to? Would you go to an attorney first? Would you go to yourself? Specialized attorney?
Excellent question. I get asked that question literally once a week. So 50 times a year, they ask me that. I get a call, hey, I want to start a not-for-profit. Actually, here's my, my elevator answer, my elevator ride answer. One, before you do that, I know it's not exactly what you asked, Neil, but I think it's great in case somebody asks you guys. First thing I say to them, how much money do you think you're going to raise with this new venture? Now, you guys ask that for your clients anyway when you want to start a business, but when they say, I don't know, or maybe 10,000, don't start your not-for-profit. Try to work with another one because there's so much involved, which leads into the answer to your question. What I tell them what you have to do is about 5 things. You have to incorporate, have your bylaws. You need to get your taxpayer ID number. You need to apply for exemption with the IRS. You need to file in your state of domicile. Let's say New York State, it would be the Charities Bureau. In New York State, you also should get a sales tax exemption to save money. Who you go to, my suggestion is you go to an attorney to incorporate. You could do it online, LegalZoom or something. I don't suggest it. And the reason is if you are a special type of not-for-profit, let's say you want to be a school, in addition to incorporating, you have to go through the Department of Education. So I really suggest you have an attorney do this. The problem is a lot of larger law firms, unless they're going to do a pro bono, it's not worth it for them for the time. But I always say have an attorney one that knows how to do the incorporation that many know, and 2 that understand not-for-profits. And I'll throw another piece in, Neil. If you're going to go to an attorney, they have to understand how to incorporate for one reason. In your incorporating documents, you must have 2 paragraphs in there that a lot of people will leave out if they do a commercial incorporation. One, how the funds are going to be used, your charitable purpose with the use of the funds. And even more importantly, if you dissolve, where is your money going to go? It has to go to a similar organization. I can't tell you how many times that paragraph is missing in the incorporation documents. I go to file for exemption and then we can't get it approved. So attorney to incorporate. As far as doing the tax exemption, anybody who has done this before, many times somebody on the board goes, I'm a smart person, I'm an attorney, I'm an accountant, I'll do it. Big mistake. If you don't know how to fill out the form, a 1023 or a 1024, you're going to run into problems and go battling with the IRS. So for that form, I suggest you go to a CPA or a lawyer who knows how to fill out that form. I think that, Neil, does that answer your question?
Perfect. Thank
Okay.
you.
You're welcome.
Yep.
Okay, so let's jump into what we were terming split interest agreements, and specifically the ones we're going to talk about, which is some of the trusts. I'm going to talk about this from an accounting perspective and also from a not-for-profit perspective, not from a formation. If you need to form, obviously, a trust with a split interest agreement, you should go to somebody experienced. Larry Shearer, this is your bailiwick, I think, how to set it up. I won't even attempt to discuss the formation aspect, but more from the practical of what the not-for-profit does with this. So just some general definitions, and for you that know this, please bear with me. For those that don't, it might be interesting. So just some quick definitions of a split interest agreement. It kind of is what it sounds like. You're splitting the interest, which basically means that a donor will contribute some kind of assets, cash or otherwise, in this case, to a not-for-profit, or place the assets in trust for the benefit of a not-for-profit, but the not-for-profit is not the sole beneficiary of the asset or the sole beneficiary of the income that the asset might generate. And in this case, usually it's investments. There are two types. One is a revocable split interest agreement, and one is an irrevocable split interest agreement. Revocable really doesn't mean much. It is I take that back, because technically it does mean something, but if revocable is a trust that basically can get reverted at any point in time and dissolved. An irrevocable is an entity that cannot be changed. I guess technically there is a way to do it, but it's involved. Again, the reason for creating this is to split the benefit. And as most of you know, it's a tax planning tool. Basically, to pull something out of your estate so it doesn't go through probate. It stands on its own and follows whatever the terms of the agreement is for distribution of the assets. Another reason for creating this is if you're going to use the trust with investments, how the income earned on it is used is important because it gets split between one or more parties. So you're creating this for tax planning and pulling out of the state or investment. And the key here with the not-for-profit is you want to do something with the not-for-profit. You either want to give them money for a number of years, or you want to leave money to them. And so this is a vehicle to benefit the not-for-profit either immediately or in the long term. As some of you know, there's a whole bunch of split interest agreements and irrevocable split interest agreement. And we're not going to talk about a lot of them, and I'm not even equipped to deal with some of these that can get very complicated. A couple of them I do deal with, and that's why I agreed to talk about at least two of these, is the ones I highlighted. There's charitable remainder trust and a charitable gift annuity. The other ones are also useful. Let's go through a couple of definitions. Again, from the background of some of you guys, this is very basic, but for the rest of us, I'll just go over it quickly. Who is the grantor? Well, the grantor is the donor. And it's basically either an individual or some entity that's giving up and donating the assets and is the creator of the trust. What's a trust? It's an agreement with an individual or two individuals or an individual and an entity. And the recipient is the trustee. And the trust talks about title to some property that is owned by the grantor and donor and going to go to the trustee. And the trust is a vehicle for protecting and in conserving certain assets for the beneficiary or beneficiaries. The trustee is the person who manages the trust, and it could be the beneficiary, it could be somebody totally different. The beneficiary is the individual, the entity that's going to receive the benefits. And I threw in another term here, which is used more for certain types of trust, an annuity. An annuity is a series of payments or receipts over a period of time. And here's where the accounting By the way, I'm going to admit somebody wants to get admitted here.
Yes, please.
Okay. See waiting room. Let's see. Admit all.
There you go.
Okay. I'm still learning this
Cool.
too.
That's okay.
All right. Let's get back to, can I get back to this? Okay.
So
So-
I kind of want to stop you right here just for a second and
Sure.
talk about a little more in depth about child remainder trusts. And one of the reasons we had you speak today. So I was involved in a meeting with an investment advisor who was talking about what they call 1031 exchanges, which is really you take a property and you're going to make a profit. And we're finding there's a lot of properties being bought and sold in Manhattan right now. Naturally, because of the pandemic, you have a lot of companies moving out. People are cashing in. And if they have a big profit, a lot of advisors were advising what they call a 1031 exchange, where you can exchange of equal value of what you sell into something else, therefore deferring the interest and deferring the capital gains. And by doing these 1031s, you can defer the capital gains. But as we run into an estate situation, deferring to what? To a potential big estate tax down the road when you're selling large pieces of commercial or private property.
Right.
So this is when I thought again about charitable remainder trusts, in which I had in my conversation, I put in a blog, which is why I had you here today. And it involves both the CPA, involves the attorney, and involves an insurance agent in some respect. So one of the things that you can do is, let's say we had a client, and Larry and I actually met with this client. They should have done it. They didn't do it because for whatever reason, but they had these two warehouses in Brooklyn, and they paid maybe $100,000 for them. They weren't using them. One sold for $1 million. He paid this huge tax on it. Okay, he needed the money, but then he put him in a further bad current tax situation. But he had another building that he was going to sell for $1 million. And true story. And he says, I don't want to pay these taxes on this again. It was like ridiculous. Why do I got to give the government $200,000? So our advice to this client was, why don't you set up a charitable remainder trust? And what would that involve? So what it would involve is, before the sale, and Larry, you can interrupt me at any time, Larry Shearer. I'm sorry, there's a lot of Larrys. Or Larry, any Larry wants to interrupt me, it's fine. So what our recommendation was to set up a non-for-profit. As it turns out, his partner had a horse farm. He had a natural non-for-profit that he wasn't utilizing, and sell the property inside that non-for-profit. And in so doing, there will be no taxable gain because you're selling it from a tax-exempt entity. So you gift the asset to the charity sells it in a zero interest rate environment. Now, the caveat is that at the end of the day, when that man deceases, that asset will go to the charity or the foundation or the non-for-profit. This is how this game is played. However, that donor is allowed to take a tax-favored income from that asset. So what we do is, you can either do what you have here as a charitable, you could do a GRAT, which is a grantor remainder annuity trust, or a GRIT and grunt. You'll probably get into that. But basically, you can set this up as an annuity, as a steady payment stream, tax favor, where you can take out a certain amount, as long as the non-for-profit has a remainder interest in the asset. And if the party wants to pass on that asset to their heirs in a tax-free world, we set up what Larry likes to call a reclamation trust, or what I like to call irrevocable life insurance trust. And with that tax favored income, we buy insurance inside that reclamation trust to replace that asset, estate and tax free. That's without showing you a chart, if you can follow my thought process. If you can't, that's fine. Ask me, I'll give you charts, diagrams, and everything else. But recognize that these situations are going to be occurring more and more, both in the estate planning realm and in the insurance realm. And it's an opportunity to do a lot of things while people may be liquidating major assets, especially people who are tired of having trouble collecting rent and just want to dispose of buildings and don't necessarily want to, they can put it in an investment or they can take a positive annuity stream for the rest of their life. So this is where a lot of this is coming from my aspect.
Well, Neil, I think that Larry is probably sitting there going, you just went through 9 of my slides.
Oh, didn't mean to.
No, actually, Larry, it's not, because I knew you guys were coming from a different angle. So no.
Okay.
But thank you for being concerned about my my emotional state. Okay, Neil, you want me to go on?
Yes, Larry Shearer, did you want to add to that?
Now,
Or-
no, let's.
No. Okay. Yes, please go on.
So I'll dovetail on what you said. It's exactly why people are setting up these trusts, not necessarily from saving taxes, but obviously that is a big piece of this. They're doing it because either themselves need the money, or a spouse or child or somebody they want to give the money to needs the money at some point in time. But they don't want to just give it away too. A lot of this is not generated from a tax perspective, although that is a really big component. A lot of it has to do with, I just don't want to give my money to people are doing that are very rich, to my dog, because I have no one else to do and I don't like my kids. It's a way to kind of mix up where the money's going to. So here I give a very easy example of a charitable remainder trust. And it kind of gets the point across. Let me admit somebody in. Okay. So this very simple is this donor, Mr. Latido, wants to get assets out of his estate and probate and wants to give it to a not-for-profit. But either Mr. Latido or another beneficiary needs the income while he or his spouse or the beneficiary is alive. They can't just give up all of their investments. They need it. But eventually they want it to go to the not-for-profit. When the trust, at the end of the life, not of the trust, of the beneficiary, the remaining assets, whatever hasn't been given to the beneficiary during the life of their while they're alive, will go to the not-for-profit. So you create this trust, which you guys, it's in your area. And again, who handles it? Who's the trustee? A lot of times it's an attorney. Many times it's a brokerage house, a bank. It could be anybody. I think you got to be a little careful here. And I think you guys probably, Larry, Shearer, you probably advise people. I would, as an aside, be very careful about naming the bank as the trustee. You guys, I don't know how many of you deal with that. My experience as an accountant dealing with people that have been the beneficiary of a trust that the bank's running, I'm amazed how poorly the investments are handled by the bank. I don't know if it's generate fees, and I don't want to make that accusation, but I can't imagine most trusts getting this kind of return. So
Right.
I find that very, very shocking to me.
Yeah. Larry, let me just point out that
Sure.
at the end of every year, when you have a charitable remainder trust, the trustee has to go and look at all the assets, look to see if there's anything that's an active business. Because if you have an active trade-up business, you could breach the regulations dealing with a charitable remainder trust. And it's important to look, because if a company has liquidated, the liquidating trust on the stock exchange is considered is considered an active trade or business in many classifications. So banks don't do that annual review at the end of the year. They want to invest in cash, and they don't want to do any active monitoring of the accounts. I find it's better to have a family member and a professional of another sort working with it.
Yeah, exactly. So you just validated what I'm saying. And when I'm talking about the bank, it would be really more of a brokerage like JP Morgan or one of those that Bankers Trust is the one I dealt with. And I'm just shocked at how bad they managed the investment. And that's just a personal observation. Okay, so as you mentioned earlier, Neil, in this case, there are two types of charitable remainder trust. There's a CRATS, which is a remainder annuity trust, and a CRUT, which is a charitable remainder uni trust. And the difference basically is at the end of the life of the beneficiary, the beneficiary that's receiving the money during the term of the trust, the balance of it will either go to the not-for-profit as a lump sum dollar amount or as a percentage of the fair market value, or I should say the distributions during the year are a percentage. I said at the end of the trust, let me rephrase that. During the life of the trust, the payments to the beneficiary are either a percentage or a dollar amount. If it's a dollar amount, it's called a CRAT. If it's a percentage amount, it's called a CRUT. Or if you want to put them together, they're a bunch of crap, but that's just.
Yeah.
Right. At the end of the day, one of the things, yes, giving to charities is a great thing, and there's certainly tax benefits, and there's certainly a moral and a lot of morality and reasons why you want to do it from that aspect. But also keep your eye on capital gains taxes. If capital gains, long-term capital gains taxes go up as a result of the government having to collect money, or estate taxes go up, or the estate tax limit is lowered, these kind of planning tools become very important in planning, especially for high net worth people, that you have to have a basic knowledge of these. You don't have to know everything. This is why we have a team of experts here at the panel. But you need to know enough to recognize a situation to pick up the phone and call myself or Larry Shearer or Larry Scott and say, hey, we have this client, he has this building, or he has this residence, or he has this, or he has that. He's looking to sell, he's looking to cash out, he's looking to move on, he's looking to make a change. I don't know if anybody remembers a book, I've read a book called 100 years ago, God Bless You, Mr. Rosewater. Anybody read that book? Written by Kurt Vonnegut. Larry, I'm surprised. Larry Shearer, I'm surprised that you haven't read that book. I have to buy it again because the first chapter talks about why this guy becomes an attorney. And he says anytime there's a large exchange of money, that's when he wanted to be around. When there's a death, when there's a business sale, this and that, that's when everything happens from a financial standpoint. And if they're prepared, it happens well. If they're not prepared, things go wrong. Excess taxes, beneficiaries not being who you want them to be, all kinds of things can go wrong in a transaction. So better to be prepared.
The rule
That's
of
why we
unintended
plan.
result.
Right. Thank you. Sorry.
Okay. Yes, again, I don't want to minimize the other benefits of the trust, but for my purposes, I can only talk about my limited universe, which is the not-for-profit. So, Neil, feel free to jump in as you are.
No.
Okay, so I said there were two types of split interest agreements I was going to talk about. Here's another one that's very popular with not-for-profits, which is the charitable gift annuity. Very similar to the charitable remainder trust, except that basically there's no trust. Here, the donor gives the not-for-profit the money. They invest it, okay? They take the income and they give either a fixed, well, usually it's a fixed, a dollar amount or a percentage to a beneficiary for a period of time. And then when the beneficiary passes away, or maybe in the case of a child, they reach majority emancipation, the money will then revert totally to the not-for-profit. Why would somebody do this? Why would they give the money to the not-for-profit instead of setting up the trust? The reason is many not-for-profits, especially very big ones, have very well-run investment portfolios, especially many of the national not-for-profits, and they're very knowledgeable about managing this. So when you give them the money, they know the money is going to be controlled, and if the not-for-profit is reputable, then they will handle it maybe better than an individual or a bank. So that's the belief when people give the money to the not-for-profit. I suggest, and this I guess applies to everything, that anybody that is going to set this up is do their due diligence. Don't just pick a not-for-profit and say, oh, you do this? You could set this up? I'm going to give you the money. I think you need to look into the not-for-profit, maybe get some references, find out if they handle the money correctly, what their board is constituted, what their finance committee is, especially if the amount you're giving is sizable. I think you need to do your due diligence. What's interesting, which you guys might not know, and this is unique to not-for-profits, not-for-profits the accounting is so much different than commercial in one major area. Not-for-profits pick up revenue when a gift or a donation is made, at the time it's made, even if it's in the future. And if it's a long-term type of donation, like in this case, a charitable gift annuity, you actually have to do what is called the present value of the annuity over its life. You use tables to do this, and not to be too much of an accountant here, but basically the entry would be as soon as this is set up and given to the not-for-profit, it is recorded right on the books. As in this case, if you're getting $1 million in cash or investments, you could see the two pieces here. You pick up a estimate of how much you're going to pay out to the beneficiary during that beneficiary's life. In this case, close to $300,000, and the remainder gets picked up as a contribution on the not-for-profit's books, as in this case that I gave, as unrestricted money. You can give it as a restriction. In other words, money is to be spent for one particular program,
Yep.
or to at the end to build a building. But in this case, I did it as unrestricted. Okay. Now, even though this wasn't the original gist of the topic today that Neil was talking about, I thought it was really important to add the rules that not-for-profits have to follow with endowments. Since trusts involve usually investments and usually many times long-term investments, I thought you might find this a little illuminating to understand what not-for-profits have to do with investments. And there's a lot of rules that they must follow for handling it. So let's just start with something very basic. When somebody gives money to a not-for-profit, you could give it one of three general ways of classifying it. One, I'm giving you money, use it any way you want that's in your general mission. It's called unrestricted. Two, I'm giving you the money, but it has to be used for a specific purpose. That is called a purpose restriction. And another one is, I'm giving you money, but you can't spend it this year. You have to spend it in the future. That's called a time restriction. And then there's another type of restriction called a permanent restriction or endowment. I'm giving you money, but you can't touch it. You can only invest it and use the money either for any purpose or for a specific purpose. The permanent restricted endowment is the concept a lot of people find difficult to understand. Wait a minute. You're giving $1 million, or I'm giving $1 million to your organization, but you can never spend it? Why would I want to do that? And the best way I answer that is, it's the gift that keeps on giving. Basically, take that, invest it, and keep using the money in one of several purposes or ways, and that will keep generating donations in the future. It's interesting to mention this because this is the rule that had to be followed for many, many years. especially you guys that deal with investments. The old rules were, if I set up a permanently restricted endowment and the investment goes down in value, the market goes down, like happened in 2008, the old rule said the not-for-profit must always maintain that corpus, that principal, at the basis that the money was given. And that means that if the value goes down, the organization was supposed to take other money, other unrestricted money, to make up the deficit of the value going down. That really hurts many not-for-profits that don't have a lot of unrestricted money and only have money that's in their permanent restriction. So as long as the investments are making money, you get the investment income, you use it for whatever the restriction or non-restriction was. The investment goes down, you get really screwed, and now I have to take my whatever cushion I have, savings, and make up that value of that $1 million. That really hurts, especially like when stock market goes down like 2008. Basically, that was a rule that had to be followed by all not-for-profits in almost every single state in the United States. And this follows a rule that came out that was adopted by almost every state. Basically, it was followed up until a revision in 2006, which was a great revision. And it falls under this act, some of you might know, called the Uniform Prudent Management of Institutional Funds Act. It's a little bit of a mouthful to say, or as people who talk about it, UPMITFA. It sounds a little easier to say. Try to say that 3 times fast. I don't know if you could, especially if you add the New York, Naim UPMITFA. Anyway, the National Conference of Commissioners on Uniform State Laws, even that's a big name, they passed this law in 2006 modifying what trustees can do with their investments and eventually changed the accounting rules of it. Every state passed it with the exception of 2, and you got Pennsylvania. For some reason, I don't know why Pennsylvania didn't approve it. Puerto Rico, which is not really a state, and the Virgin Islands. New York passed this in 2010. And unlike the old law, it added one word in here, which really significantly changed the rule. I highlighted it with the word prudent. Instead of it, the old rule was called the Uniform Management of Institutional Funds Act. They added the word prudent, which is a little bit more than just saying you got to be careful. It told you I can now do something different with my investments. What it said basically is, even if my investment goes down under the original value, and that's called underwater, I could still take some of the money out and spend it on either unrestricted or restricted purposes. And that significantly changed around because they basically said, just be prudent about it and how you use the money. And don't say, oh, it went down, but next year it's going to go up 20%, so I'm going to take out 10%. And that really changed around. That wasn't the accounting rule. That was the laws that that investment people were supposed to follow. But the accounting rule caught up to that. So I have a little example dealing here. I could kind of skip down a little bit, but in this case that I came up with a simple investment, $1.2 million back in year 1 or the starting year. The next year, the investment goes down to $1 million. I have an unrealized loss. I didn't sell anything. I have an unrealized loss of $200,000. Beginning in 2018, and to align with this rule, I think it's 49 states. I have to check if the other one was only Pennsylvania, so I have to look at my slides. But basically now I could take money out even if this went down. Every state gives a guideline. New York State has, since we deal with New York State, basically says you shouldn't be taking more than 5% out of your investment to be prudent. You can, but basically the average should be about 5%. Now, the accounting rules finally caught up all the way effective beginning in 2018 under an accounting standard update that says for you guys that have to read or want to read, if you have board a financial statement, there's new disclosures on your investments if it goes down. If you have an, and when I say investments, I mean your permanently restricted endowment.
Mhm.
If you now, these are new rules that came out was the accounting standards update. I don't throw out the new rule number 21614, but it's effective. It's basically effective for the years ending after 2018. So it started in 2019 and basically says you now have to disclose your policies of spending money when your investments go underwater. And I'm not going to read this. If you guys want, I'll be happy to share the notes to you and give it to you. So I don't lose the rest of you with getting too mundane here. I'll just skip over it. But the gist of it is saying that tell the reader what you're doing and why you're taking the money out, even though you're not making any money on your investments. Here's another thing that you were talking about before a little bit when we were talking about giving money to, well, you weren't really saying, but you're saying when banks handle it. If an investment company is going to handle the not-for-profits investments, many times donors say, I want my money to be used for program 1. Another donor says, I want my money to be used for your restoration of your historic building. Donor 3 says, I want my money not to be used now. You guys are doing well. I want it to be used in 3 years. All of these donations have some kind of restriction in it. If the not-for-profit is large, let's say a very large one like United Way or something, or even some of the colleges, Columbia, NYU, and people are giving money restricted, I'm giving it for this school. If you had to set up 1,000 different endowments, it would be cost ineffective. It would be very difficult to manage, brokerage fees, the return on your investment. So what most, if not all the big not-for-profits do is they pool their investments, their permanently restricted endowments into one. But here's where the difficulty is. How do you manage the restrictions in each one? And how do you make sure that somebody giving money now doesn't get the benefit of the appreciation over the last 10 years? When I worked at the CPA, which I did years ago, my job was to handle their benevolent fund. And people were giving little bits of money. I want to give $1,000 in my husband's name. He was a CPA, passed away. But I want it to be used like this. The way a pooled investment fund works is when the money comes in, there's a ratio of how much it's worth versus the portfolio before. And this allocation is made. And again, I won't get too technical, but you're able to come up with a specific percentage of your donation to the total portfolio, and it creates something called units, and those units are then used to meet the restriction of the donor. And again, I won't go any more than that, so I don't have you guys totally falling asleep. And that's the end.
Fantastic. Thank you, Larry. What a terrific presentation. Is there any questions? By the way, everyone's going to get a recap of this meeting. And if there's any questions, please, we're going to forward Larry's information out to everybody. If you have any questions now, happy to answer.
Well, I wouldn't mind if I could just give an example of how you apply some of this stuff, especially tying in Neil to Larry's presentations. There was a person who went to I believe it was a garage sale, and bought a very old frame. And hidden in that frame was one of the 13 Declarations of Independence. That one declaration was worth about $3 million. Having paid $3.50 for it, there would have been a large capital gain, or in this case, depending on holding period, potentially just ordinary income. So what we would recommend if it was us all representing that one person, we would set up a charitable remainder trust, drop the document into it, sell it inside the trust, thus avoiding the immediate recognition of income. And then from the tax deduction, which would be very small, and the potential income annuity that's coming out, purchase life insurance, and thus avoid estate tax, avoid probate, and to some extent avoid the recognition of income in the short term. Simple.
Excellent. Well
Okay.
put. Thank you. Okay, everybody, listen, have a terrific day. If there's anybody wants anything further, please don't hesitate to ask. Thank you for coming, and we'll see you in 2 weeks with our next big meeting.
All right.
Have a
Take
good
care.
one, guys.
Take care, all.
Bye-bye.
Okay, good job. Bye-bye.
Thanks.
Thanks, Larry.